Hello, and welcome to this webinar by Nicola on the family business life cycle, creating and distributing wealth. My name is Rick Goossen, and I do business development at Nicola. One particular focus of mine is working with owners of family businesses on creating wealth through careful strategic planning and succession transition planning. Over the past 15 years, I've worked with approximately 100 family business owners of varied backgrounds and in varied industries. Yet it's quite fascinating. The same issues arise time after time with respect to growing a business and creating wealth. I will share those lessons with you during the first half of this presentation on how to create wealth in a family business. I will be presenting along with my esteemed colleagues, Karisa, Schaitel, and Haik. They both have extensive experience on the financial planning aspects of working on family businesses and how to distribute wealth effectively. Their bios, along with mine, are on the Nicola website, so you're welcome to check those out. I'll begin the presentation, and then Karisa and Ron will join in as their subject matter items come up. Before we get started, let me introduce a few housekeeping items just to make this experience as interactive and as positive as possible. First of all, throughout the presentation, please submit any questions you have to the Ask a Question tool. It's located below the live video field. We'll integrate questions throughout the presentation, so I really want to highlight that this presentation is intended to be as interactive as possible. So we won't necessarily wait for questions to be posed at the end, but when you have a question, just ask it and I'll integrate it as we go along. Secondly, if you wish to add subtitles to this video, please make sure you click on the closed caption button at the bottom of the live video. So that may be of interest to some people. If you have any questions about the On24 platform or need some assistance, please use the Ask a Question button or connect with our team, or alternatively, click the question mark at the bottom of the screen for some troubleshooting. I'd also like to highlight that we will go exactly an hour. We want to respect everybody's time, and so we'll try to start, we start on time, and we'll look at ending exactly within 1 hour. So to begin the presentation, let me provide a bit of information on Nicola. So Nicola Wealth was founded in 1994. Nicola is licensed as a portfolio manager, exempt market dealer, and investment fund manager with the required provincial security commissions in Canada. We have offices in Vancouver, Kelowna, Richmond, and Toronto, and we manage over $11.6 million. And most importantly, as you can see highlighted there, we work with approximately 2,400 families and their wealth and their businesses. So we have a lot of expertise when it comes to creating and distributing wealth with our clients. Our focus is private wealth management of families, foundations, and trusts. Interestingly, we provide a high level of service, and we have a minimum of 2 advisors on every file. For example, I work closely with Chris and Ron, so they're often the 2 advisors on files that I'm involved with. We work carefully to understand the life cycle for different professionals, executives, and business owners. Because, of course, people have very different needs depending, if they're 30s or 40s, or if they're in their 60s, 70s, or 80s. Planning is first and foremost what we do. That's a big part of the service offering for clients. And I'd also point out that we have unique assets that are typically available only to high net worth clients. All right, so let me move on with the presentation. Again, thanks for joining us. Look forward to interacting with everybody. Now, it's quite interesting. The title of the webinar talks about creating and distributing wealth. So have you ever thought to yourself, you're working hard, you're creating wealth, and very few people can time their passing with reaching a zero balance. So if you think about it, that's a pretty hard thing to do. Predict the exact time when you'll pass on and have all your money spent. So of course, most people leave behind some money, something in their estate, something they'd want to pass on to loved ones, to family members. So then the question would be, what will that person do with it? And of course, most of us want to be good stewards of whatever wealth we have and make sure we provide for loved ones and maybe support causes that are important to us. But this issue of who will get the money, well, you might think this is a new concern, but in fact, it's not. This issue came up 2,500 years ago. So you have the writer of Ecclesiastes bemoaning the fact that I hated all my labor in which I toiled under the sun. It sounds like this poor fellow is, just grinding it out in the salt mine because I must leave it to the person who comes after me. So obviously he can't spend all the money, so somebody's going to get it. And who knows whether they will be wise or a fool. It's almost somewhat tragic. I worked like crazy my entire life. There's going to be something left over, but what if I just leave it to somebody who squanders it? Well, that's a big concern. It was a concern 2,500 years ago, and it's a concern today with clients, and it's a legitimate concern. Now, this then ties into the aspect of the family business, because often people work with family members, and when you pass it on, you look at passing it on to family members. So what about the family business? Well, there's many different types of family businesses, and probably like a lot of people listening, I've watched the Godfather trilogy a number of times. Obviously the first two Godfather installments won Oscars for Best Pictures, so it's quite a well-known story. And you can say the Corleone family, well, that was a family business. And here's a little silhouette of Al Pacino, as Michael Corleone says, "Today I have settled all family business. So don't tell me you're innocent, Carlo." So you remember Carlos was the fellow who was the brother-in-law who, let's just say, it didn't end well for him. So family business can have challenges. But at the same time, there's lots and lots of successful family businesses. So here's a great example. I'm not sure how many of you would have thought of this, but there's family businesses that have not only lasted successfully for 2 or 3 generations, but in fact have lasted almost 1,000 years. Now, a lot of us, of course, would appreciate fine wine. So here's a great example of an Italian winery that stretches back to 1141. So lots of examples of successful family businesses. But let me get back to the key issue of our presentation and what Ron, Karisa, and myself will cover. Creating and distributing wealth. Those are 2 separate components of the wealth equation. So on the one hand, you have to create the wealth, make sure you're stewarding that opportunity of the business. But secondly, that can be squandered if you're not distributing it properly and tax efficiently and effectively. So that's really what the focus of this presentation is. For a lot of you listening, and we know we have a number of clients and other individuals who have family businesses, and this concern is real and very vivid of I'm working hard, I'm building up my business. How can I create more wealth for people and causes that I love? And then how do I distribute it effectively? So how do you create wealth? Well, value is created by making the business appealing to potential purchasers, whether other family members, acquirers, or financiers. So what we mean by that is, even if you think the business is just for myself, maybe for a few family members, we should all think of it from the standpoint of what are indicators of value of a business? How do you increase the value of the business, build a system, build something that's almost like a turnkey operation to enhance its value, just because we don't know what direction we might go in the future in terms of retaining it, selling it, transferring it to management, or passing it on to family. So you really want to focus on what are the indicators of value. Now, the goal, especially for a family business, is to change the typical life cycle of a business and allow it to succeed for future generations. Now, this is something that we alluded to in our title. We very deliberately chose the title, The Life Cycle of the Family Business, because the life cycle is critical to understand, because otherwise people won't be able to have their family business succeed to future generations. So we're going to look at what some of the very basic stages are in the life cycle. Now, this slide is a little busy and it has some headings at the top, and I realize that they're difficult to see, but really what I wanted to get across in this slide is just for you to see that curve. Now you can see how the line starts to go up. So the stages are, there's the seed and development stage, right at the start. Then there's the startup, the growth, the maturity, and then decline. But you can see on the right hand, there's a dotted line that starts heading upward. And that's the critical point where a company either survives or dies. Now, the reason we talk about the family business and the life cycle is that, we've all heard these cliches about, rags to riches in 3 generations. And it's really interesting. That cliche exists in virtually every culture. I lived in Hong Kong for a number of years, and in Hong Kong, same concept there. Europe, same concept. Everywhere you go in the world, the same concept of family businesses often don't survive more than 3 generations. Well, that's because they haven't been able to navigate this business life cycle. And we're going to talk about how you can create value and avoid a decline by the 3rd generation. Now, what people have to bear in mind is that while the family business may have succeeded early on in the cycle, things keep changing. So there's changing markets, changing risk tolerances. So for example, the family member who maybe started the business might have been a very aggressive risk taker. But what happens often is that the 2nd generation is more custodial. So the 2nd generation doesn't want to mess things up, doesn't actually want to take risks, because they may have gotten used to a certain level of lifestyle or a certain level of wealth, and they're not interested in doubling the size of the business. So their mentality may be very different than the founder, who may have been risking a lot and really building the business. So company and the family has to bear in mind, obviously, changing markets, competition changes, risk tolerance changes. So it's really important for family members to understand how that life cycle works. Now, it's quite interesting when we talk about creating wealth. Like what I've seen with all these family businesses that I've worked with is that wealth can be created through building a well-run company, which is a fascinating point. So beyond just a unique product or service, just by being a well-run company, being consistently profitable. I mean, we've got clients like this who they've been in a business maybe 20, 30, 40 years. I have a number of people I've dealt with who've got businesses that have been around 50 plus years. And even though they're in a tough industry, they know how to run that business well and run them profitably. So that's a way to create wealth. The key thing is you want to build almost like a turnkey operation where it can run effectively, well-managed team, clear market focus, and it's profitable. So that's a way to create wealth. Now, as I'm about halfway through my remarks, and then I'll pass it on to Karisa, I want to just summarize with 5 aspects of creating wealth. So these would be the 5 takeaways. And of course, this presentation will be available via recording, so you can refer back to this if you'd like. So I'll go through these quickly, but here's the 5. So the first one, good communication and transparency. Now, all these things are related to creating value, creating wealth. It may seem like an odd thing to say, well, how could good communication and transparency actually increase the value? Well, anything that increases the ability of the company to function efficiently and effectively with minimal distraction and focus on its clear mission and purpose, that's going to add value. So good communication and transparency. The reality is, as I'm sure many of you listening in, I know, would say, well, people don't communicate well. How do so many problems arise? Miscommunication. And that includes families. So even people who've grown up together, know each other well, they still don't communicate clearly. And when money's involved, it gets a lot more complicated. The money can be like throwing gas on a fire. It just explodes and people harden their positions, and it gets a lot more challenging. And often what happens is promises are made and forgotten, circumstances change, there might be certain assumptions. So let me just highlight a couple of things in terms of good communication. I've had owners of businesses who've made offhand comments. So for example, here's just a classic. So let's say the father. The father has 2 sons, but he also has a daughter. And the daughter gets married to a fellow. So now there's a son-in-law. And so the father says at the wedding, "Oh, John, this is great. I treat you like my own. You're like another one of my sons." Okay, that sounds good. And it's probably a good thing to say at the wedding. Everybody's cheering and toasting. It's all good. So I have a case where when push came to shove, this same fellow passed on the business to the two biological sons, and nothing went to the son-in-law. Well, when I asked the client about it, I said, "Well, what happened to the son-in-law?" "Well, it's not quite my son. I mean, yeah, I did say that, but, it sounded like a good thing to say at the time." Well, meanwhile, the son-in-law, he thought, well, my father-in-law had made that comment, and I married the daughter, who's the oldest. So in effect, although I'm a son-in-law, I really stepped into the number one son position. No, that was not what the case was. Bottom line is, this family had an intractable problem which was never resolved, and it affected family gatherings, and it was a major, major problem. So that's just a simple example. Good communication, clear communication is key. One thing I always say to clients is that family business transitions usually fall through because of poor communication rather than poor technical planning. So the communication is critical. All right, second one, shareholder agreements. So I've got just a few minutes left on my part. So shareholder agreements. It's quite interesting. A lot of businesses don't actually have shareholder agreements. Now, of course, from a legal standpoint, there's the Company Act federally, and there's provincial Company Acts. So there's general guidelines dictating what can happen in companies and how companies function. But the reality is, you need a shareholders agreement to deal with certain key provisions. So one is simple buy-sell provisions. Now, a common thing that comes up is if there's, let's say, 4 family members in a business, let's say they're all married. So typically a business person would say, well, if so-and-so passes away, I don't want to deal with her spouse. So maybe the daughter was involved in the business. If the daughter passes away, now the spouse is sitting at the table with the rest of the business owners, and they'll say, well, we don't want to be in business with this person. So therefore you have provisions, insurance provisions to take this, have an insurance policy on the individual's life by the company and be able to take out that person. Well, what if you don't have that? Then you've got a mismatch of people running the company. Another thing that often comes up is this so-called shotgun clause. And shotgun clauses can be quite effective, that at the end of the day, if parties aren't getting together, either you buy me out or I buy you out. And that's a very common provision, but not everybody has a shareholders agreement, and not everybody has those provisions clearly outlined. But again, agreements are critical to have in place. Thirdly, good governance. So again, this may seem like an odd thing to put in this presentation about creating value, but in fact, good governance does create value. Think of the company as something that needs to be run as efficiently as possible. And just think of building the skeleton for the business. So it's as simple as you have people in the company, do they have job descriptions? Do they have clear job descriptions? And is it clear how their performance is reviewed? So clear job description, clear way to review somebody's performance. Also, who are they accountable to? Well, that's another thing that's quite important. So often in family businesses, it's quite interesting when I ask family business owners, well, is there a job description for the cousin who just doesn't seem to be doing any work? And they'll say, no, we actually have no job description. Well, how do you keep the person? They might say, well, this family member's not doing what they should. Well, who are they accountable to? On what basis are they accountable? So these things are very vague and unclear. So you need to have clear accountability, clear job descriptions, clear reporting. That works all the way up the structure of the organization to where you have the executive leadership team functioning well with the board, and the board and management team clearly knowing their responsibilities. The board empowers the management team to run the business. The board is not running the business. These most basic things that often aren't understood well by family members. Now, fourth one, and again, I've got about a minute or two left on my segment. So fourth point of the 5, entrepreneurial culture. I'm sure a lot of people listening can quickly grasp what the point of this would be, that many businesses, and of course family businesses, were started by an entrepreneurial person. And that entrepreneurial person may have come up with some great product or service, and that was the reason that the company grew. Now all of a sudden you get the next generation taking it over, and they may or may not have that entrepreneurial spirit or entrepreneurial spark. They may still be riding the momentum of the original founder entrepreneur. So the key thing is the company has to have an entrepreneurial culture that's focused on how the company operates. And there are ways to create an entrepreneurial culture. So that's what the company has to develop, not have the focus be on the one individual who was previously entrepreneurial and we're still looking backwards rather than looking forward. Now, the last one, systems, not personalities. Now, again, this will be clear to, I'm sure, most or virtually everybody listening in, that when you're building value in a company, it has to be structured around systems, procedures, building a turnkey operation, as opposed to structured around personalities, because people come and go. So in any organization, whether it's a nonprofit or a for-profit, you have to focus on the system, not just the person. Building out a team that can execute a plan that's not dependent on a person, because often in an entrepreneurial environment, you have an entrepreneur-centric model, meaning that the entrepreneur is like the sun and the team are the planets revolving around the sun. Of course, the sun disappears, all the planets are in big trouble. So one way to view this is, for those of you listening, think about, success for you and your company is measured not by how much people need you, but by how little they do. So the old joke about if you go for 3 months and nobody misses you, that's a good thing, because you've built a system that's not dependent on you. So that's my introductory remarks, focus on creating wealth. And just to remind everybody, the title of the presentation is The Life Cycle of the Family Business. We're tying into the life cycle. We're talking about creating wealth and distributing. So I just highlighted a few things on creating wealth in the family business context. Now we're going to focus on distributing wealth, and that'll be covered by Karisa and Ron. And I'll now pass things over to Karisa, who will take it from here.
Great. Thanks, Rick. So Ron and I will be talking about distribution, as Rick had mentioned. These are common communications or chats that we have with our clients around the distribution of family wealth, specifically as it relates to tax minimization, wealth management, risk mitigation, and estate planning. And then we'll tie it all together, put a nice bow on it for you at the end. So with tax minimization, when you're looking at distributing wealth, one factor would be compensation planning. So as you know, as business owners, you can decide how you structure your compensation. Does it make sense to pay out a dividend or salary or combination of the two? This may likely be influenced by corporate tax rates or certainly personal cash flow needs. Also, if you have a spouse, are they helping out with a business? Is there an opportunity that would warrant a reasonable salary to get funds into their hands and utilize some of their marginal tax rates? So this is something that, we would suggest to review every year, certainly with your accountants, not to set it and forget it. Good news about getting a little bit older or more mature. As we turn 65, their CRA had put restrictions in place that kind of limited how we can distribute funds to our spouse, and that lifts at age 65. So there's always a silver lining to maturing, as I like to say. And then really personal savings and corporate savings. So if we're looking at saving personally, that's going to tie into how you're compensated. If you're generating a salary and you're generating RSP contribution room, you may want to start funding those to start accumulating wealth outside of the corporation and to have personal funds to cover personal expenses down the road. In addition to that, you can consider spousal RSP contributions. That would be another way of splitting income with your spouse in the event of wanting to draw funds out prior to 65, where that is the age where you can traditionally split your RIF income. But this would be prior to that. There are nuances to the timing of when you can withdraw, but certainly a consideration. On the corporate side, there is a tax deferral to save corporately, and as you're accumulating wealth in a corporate entity. Over time, though, you may find that the wealth that you've built up and the income that spins off, the passive income may start to reduce the amount of the small business deduction that you would have in your operating company. So the small business limit does reduce to zero, as you can see in this chart, as the passive income increases to about $150,000. So not necessarily tied directly to that, but certainly if you are approaching this threshold, another opportunity might be to start contributing into an individual pension plan. So contributions into an individual pension plan would be a deduction for your corporation, as well as any admin costs to run it. While at the same time, you would maximize your registered savings. Another benefit to an individual pension plan is that there are higher annual contribution amounts that you can contribute. So, and those contribution amounts increase with age. Silver lining number 2 for maturing. Potentially, when you're looking at a business wind up or exit or retirement, there could be additional tax sheltering strategies at that time that an IPP may be of value for. Typically, you're looking at being at least 40, possibly older for this to make sense. And you would be a higher income earner with often a history of T4 employment income. Well, IPPs would be a deduction for the corporation. Corporate-owned insurance is another way of saving, in that if there's excess funds, you find you have excess funds available in the corporate entity, you could use cheaper corporate after-tax dollars to fund the premiums. And so this differs slightly in that the investment income earned in an exempt policy does not affect the ability to claim the small business deduction, as mentioned earlier, and it's another opportunity and asset class in which you can build wealth. And
sorry, Karisa, we've got a question here. Although I did want to make a comment, I think one of the major takeaways from this morning is that you're basically saying it's not a bad idea to get older.
That is what I'm saying.
Okay, so for all of you let's just call it 55 and over, this is good news. But anyways,
not only tax tips, but also perhaps some silver linings too. Yeah,
right. There's a lot of silver lining as you age. So there's a question here: how do you eliminate the tax on large corporate gains simply by having an IPP?
So that would be when you're looking at exiting, for example, where that would trigger some corporate tax. There's an opportunity, it's called terminal funding, where there could be a large sum. This is where you work with the actuaries and they'll crunch the numbers for you and let you know what you could essentially top up when you exit a business. And that would be an offset and a deduction, a large deduction to the corporation at that time.
Yeah, okay, great. And just to remind everybody, we're already halfway through the presentation, and so if you have any questions, keep forwarding them, and I'll pass them on to the presenters. Sure, thanks.
Thanks, Rick. I'll keep moving on. One final point, of course, is that life insurance proceeds above the cost would be paid out tax-free on our passing. Charitable giving. So, of course, we know that this can be done both personally or corporately, but if we're looking at the corporate entity, corporate donations are a deduction against the income. So, and it would be the full value of the donation that you make. So donations that are made in kind, meaning they are, for example, a stock that has appreciated in value, you don't sell it. What you do is you donate the position in kind directly to the charity, and it would eliminate the accrued unrealized capital gain. And one additional benefit for corporate donations is that the non-taxable portion of the capital gain. So let's say you have a cost of 10, appreciates to 30, the 20,000 capital gain, the full value would be credited to a capital dividend account. And this account is a notional account, which I will talk about, but it allows shareholders to draw out tax-free dividends. We like this account. And so I'm going to just explain a little bit more about that in the event that you may not be familiar. So the capital dividend account is a special notional corporate tax account, and it tracks tax-free components or surpluses, which can ultimately be paid out to shareholders as a tax-free dividend. It's made up of capital gains offset by losses, so it is a fluctuating balance. Proceeds of life insurance would also go through the capital dividend account, and as well as dividends received from other companies. So as part of our planning, we like to keep an eye on this account and look for balances and look for opportunities in which we can draw from at the corporation tax-free. When we might do so would be if a business owner maybe hasn't been funding their tax-free savings accounts. When the capital dividend account balance reaches a certain value, we could withdraw. This works with your accountant. They make an election. We draw from the corporate account tax-free and use it possibly to fund your tax-free savings accounts. We like that because it perpetuates the tax-free nature of the dividend into the tax-free savings accounts. We've also seen clients intentionally trigger capital gains within the corporate account to build up this tax-free component if they're planning or they know that they're planning to assist or gift to their children. Of course, it means you are prepaying tax, and so that may be a deal breaker for some, but for others, they may realize, okay, well, at least I'm paying tax at an efficient rate. Also, from this account, this capital dividend can be paid out to a spouse without any income attribution. So traditionally, we can't just gift over or give money to our spouse without having that income earned follow us and come back to us. This is not the case with a capital dividend account or a capital dividend paid out. And as I had mentioned, pardon me, there is the charitable giving piece, that the charitable giving, when you do donate, that component of the gain that isn't realized would all be credited to the capital dividend account. Few more pieces here to talk about some tax minimization. Looking to speed this up. I don't want to eat into all of Ron's time. Prescribed rate loans, you may be familiar with this. Often lend funds to a spouse or a family trust. So if you do have after-tax or tax-paid capital available in the hands of an individual that pays tax at the highest marginal tax rate, you can lend funds to your spouse or family trust, and that income generated would be taxed in the hands of the spouse or children, and benefit from the lower marginal tax rate. So you're saving in that tax differential. Right now, prescribed rates are 1%, and that's locked in for the length of the loan, not affected by any future rate increases. And as an example, if we're lending funds to a family trust and the family trust has minor beneficiaries, the income that's generated from the trust could be used to pay for expenses that are directly related to to the beneficiary. So as an example, private school tuition, sports activities, camps, that type of thing. And this income would then be taxed in their hands at the lower rates. Capital surplus strip, you may or may not have heard of this. It's a simple statement for a complex transaction. Essentially, it's a tax strategy to withdraw funds from your corporation at capital gains rates versus dividends. I will make note that it is a transaction that CRA is familiar with and does review. And some individuals or accountants may feel that that may be a bit more on the aggressive planning side. So just like investments and your tolerance for risk on the investment side would be similar with tax planning. Some may be shy away, others may be more for it, but that is up for you and your accountant to determine. But there is a cost to execute on this. And of course, should the capital gains inclusion rate increase, it may make this strategy less compelling. Flow-through shares. Flow-through shares would be a consideration for an individual that is a high income earner, taxed at the highest marginal tax rate bracket. Flow-through shares have generally been considered to be a speculative investment in resource companies. However, it's recently been expanded beyond oil, gas, mining into areas such as renewable energy or energy conservation sectors. So those who would purchase or purchase shares would receive 100% tax deduction. And CRA then also allows for the underlying holdings companies to pass along their Canadian exploration and development expenses as well as tax credits to you, hence flow-through shares. And there are companies out there that we work with where you can buy the shares through them and they secure the price, which removes the stock market risk or price volatility and does provide immediate liquidity. So that's an option for those investors that may want to go use this strategy strictly for the tax benefit piece rather than the investment component. And wrapping up here, estate freezes, pardon me, and the lifetime capital gains exemption. So estate freeze, simply put, is a business succession strategy to cap the value of your shares from a tax perspective. And if the planning put in place will allow you to continue to participate in the future growth of the business, but ultimately the plan here would be business owner wanting to pass along the future growth of the business to family members or others. And of course, lifetime capital gains exemption, we all have access to this. Right now, it's just over 900,000, and it's utilized to shelter any of the sale of up to the 913 sale of qualified small business shares. There is planning that goes with this for purification, so it does take some time. So again, all of these ideas working in collaboration with your accountant. However, you can also potentially multiply the lifetime capital gains exemption across beneficiaries if a family trust is a shareholder. So not an exhaustive list by any means. However, just wanted to provide you with some examples of tax efficient strategies that we communicate with our business owner clients.
Karisa?
Yeah.
Yeah, so there's a couple of questions here. So the first one relates to the CRA has been in the news lately over more aggressive auditing and tax rulings. It seems to me that the strategies or some of the strategies that you're referring to, how risky would they be, and how do you advise clients in terms of, pushing the envelope, so to speak, in terms of tax planning strategies?
That's a great question. Like I say, I think it's agreed. Some of these are, CRA is shining a light on some of these strategies for sure. It's understanding the what the risks would actually be. Is that could this income be recategorized and you'd pay more tax? What is the accountant's experience in putting these transactions together with clients, and really just weighing out the pros and cons, the risks, and whether or not you're willing to sort of run that risk of A, if I'm audited, and two, can we really put a solid case for it? Often, for example, with capital gains surplus strip, it may be you would need to have an absolute reason and valid reason as to why you would want to extract funds from the corporation. Some people will do that to pay down personal debt or buy property, for example.
Okay, there's one more quick question before Ron comes on. What is involved in setting up a CDA, a capital dividend account, and is this specifically for corporations?
Also great questions. Thank you. So it's actually a notional account that accountants will track. So as a corporate, and it is only for corporations, it is to equalize tax from a corporate entity. Compare that to personal individuals. As individuals, we only pay 50% on capital gains. This is a way to equalize that for a corporate entity. So yes, just for corporations. And it is just a notional tax account, so no setup required. Accountants will track gains that are triggered in a corporate entity offset by losses. We do planning around that because we do like to check in on those balances. Often accountants will have a certain threshold where it will make sense because they do have to do some work and there's a small cost to doing that. So if it makes sense for them to elect, I'm throwing out a number here, and hopefully most accountants won't shoot me for it, but it's, maybe you have to have a buildup of 30,000 or something like that in this account, and that's going to be accumulated net capital gains that you have triggered over the course of time in your corporate account.
Okay, that's great. Well, we're going to move on to Ron Haik. He'll cover the last 20-minute segment of the presentation. So Ron, why don't you proceed? And again, I'd just encourage everybody to ask questions and I'll present them to Ron as we move along. So Ron, over to you.
Thank you. Thank you, Rick and Karisa. We're going to focus on the next few slides on the management of the wealth that you've accumulated, how to pass that on effectively, what are some of the trips and traps that exist out there, and how to deal with those things. The first thing when it comes to you've accumulated the wealth, it's now maybe time to take some of that money off the table and reduce the concentration risk. Karisa did a great job of indicating how one could pull some of that capital out, either personally or corporately, but it's important to diversify beyond your business. Certainly that's where your business has built up that wealth. How do you now diversify across? And when we talk about diversification, it isn't diversifying into stocks and bonds. For some people, it might be diversifying into another line of business. And for most of you business owners, your business was like an ATM and is an ATM. It's generating that cash flow. And when you go to retire or transition to that next phase of your life, you want to ensure that your portfolio is generating that same kind of cash flow to ensure that it is supporting your lifestyle. So we all know in business, cash is king, like all businesses. So how does one do that? This is a sample of a core fund, our core fund. And what you can see in terms of diversification, it's very different than the typical 60-40. We typically, for our clients, will have an allocation to hard asset, real estate, private equity. Again, very much like your business. It was a private business, privately run, private debt. These are assets that typically you're not going to get with your traditional stock and bond model, whether it's alternative mortgages. In a traditional model, you might have 60, 70% of your portfolio in public equities. In our model currently, it's somewhere around 21%. So you've got to offset it with different kinds of asset classes. And these asset classes, like private mortgages, private debt, real estate, and the alt strategies, they need to create that cash flow for you so that it can sustain you in periods when markets are up and down. This is on our website, as was the previous slide, so feel free to go there. It just shows you that, from when we started running this model until February of 2022, we have outperformed, our core composite has outperformed a 100% equity, whether it's a S&P Canadian dollars, a world index in Canadian, a balanced fund, or a 60-40 ETF type portfolio. And so the good news is we're that top line. But, averages can hide a lot of things. What you don't want to see is a lot of volatility. You're retired. You've taken that money off the table. You don't want to see a lot of drawdowns. So when you start to look at the performance of that same core composite over that same period of time, the good news is, again, we're the blue, the purple is the benchmark, and you can see when there are drawdowns, like we had in 2000 after the tech crash, when we had in 2008, 2011, and again in 2018. When you have those drawdowns, our clients are just not participating in that drawdown. But it doesn't mean they're not participating on the upside. It's being able to pivot and reposition your clients, your portfolio, to ensure that you're not taking on that kind of risk. So that's the first thing. Managing the wealth that you've accumulated is really important. The second thing I'm going to talk about is mitigating the risk. So when you start your business or you're perhaps in a new relationship, you should be looking at cohabitation agreements. You should be considering creditor protection. So that could be as simple as having a lot of cash flow in your operating business, which you don't need, and just setting up a holding company to flow funds out of the operating company, reducing some of that creditor assets that they could go after. A big part of what we talk about, Rick talked about earlier, was succession planning. This is one of the critical things in running any business. Ensuring you have a plan at all stages of your business. And that includes ensuring that plan, whether it's for key people, maybe you have a CFO, a salesperson that's key for everything, and ensuring that the shareholders agreement is in place, as Rick talked about, the unanimous shareholders agreement. And you want to make sure there's buyout insurance in place, whether it be for family or other individuals within the corporation. And so again, using those corporate-owned dollars to buy that insurance for not just tax planning, but there are other future opportunities available to you through that. So risk mitigation is a big part of maintaining the wealth that you've got. So a big part of what we deal with every day here at Nicola and with our clients is the estate planning piece. And I want to start off with saying what's fair is not equal, and what equal is not always fair. It's not up to us as advisors to impose our values on you. It's to understand your values, your family's values. What's important to you? How do I want to transition that wealth? And so you need to be, absolutely, wills are a basic component, but you need to step beyond wills. Think about letters of wishes. For those who might not be familiar, this might cover material non-financial assets. I have seen lots of family fights over, the piano that both kids played. Who's going to get that one piano? How are we dealing with these items that are of sentimental value? Where permitted, you should be looking at a secondary will. BC and Ontario, for example. These are things that we want to look at. And secondary wills offer an opportunity to save on probate and provide some privacy from the prime public eye because they do not go through probate. So in Ontario, if you have a $50 million business and you don't have a secondary will, that's $750,000 of savings right there. Surely that's worth, some billable hours for a lawyer. Think about your foreign wills. Many clients aren't aware, I've got a vacation property in Arizona, Costa Rica, whatever it might be. Be aware that your Canadian will, how is that going to be received down in a second country or a foreign country and covering your foreign assets? So it's important to have those powers of attorney, not just here in Canada, but you also want to have those powers of attorney drawn up where you are residing for the winter months. Other things that we see with clients at this stage is the secondary property. So if you have a cottage and it's very important to you to have that cottage for the next generation, consider setting up a trust that holds the cottage, that holds assets in there in order to fund the cottage ongoing basis. Maybe a trust deed that outlines who gets Christmas, who gets Easter. Because if you're going to leave it up to the children or the spouses and the children, there could be some problems. And when you start thinking about the next generation, we've got cohab agreements. I can recall an example of a good friend of mine from a very prominent real estate family. Literally the day before he got married, he came to his son. He said, here's the prenup agreement. You get your spouse to sign this or you're cut out. These things are important to communicate and have those discussions long in advance. Quite important to have those discussions. We talked about the issue earlier, Karisa did, about a family trust. That's one way of ensuring that the next generation is looked after according to the values that are important to you. And when you think about values, Karisa and I could, be sitting in front of a certain set of fact patterns today. And the outcome could be completely different for three different families because this is all based on family values. It's not a tax-driven discussion. It's a family value discussion. And often what we'll see is a discussion around helping the kids. Well, especially the cost of housing in Canada. If you're living in a major metropolitan area or anywhere in Canada, I want to help my kids. Well, should I give them a gift? Should I give them a promissory note? Or should I register a mortgage? And the answer, like most things, is it depends. Depends on your values, depends on what we're trying to ensure, and ensuring that, we're having a great line of communication with our clients. And one common thing that we do see with a lot of our clients is philanthropic goals. Karisa talked about this. This could be achieved both, personally, corporately, but it is important, we think, to involve your family. And Nicola, we do have a private giving foundation that certainly helps facilitate many of those things.
Yeah, Ron, if I can just interject here. So for people listening, there's a lot of points you've covered regarding estate planning. In your experience, what would you say is perhaps the key thing that always seems to come up?
Good question. So I think I would say too many people, especially those who are running businesses, are operating in silos when it comes to the families. So, in your business, you wouldn't have, your marketing people not talking to your business development people, not talking to your customer service, and not talking to your fulfillment people. It's an integration. Maybe I'll quote, you quoted The Godfather. I'll quote a line from Cool Hand Luke, 1967. There was an actor by the name of Strother Martin. He was the villainous captain. And he said, famously, what we have here is a failure to communicate. And that line has always resonated with me because, it is about listening as much as it is about speaking. And it's being open to different ways of doing things. Maybe it's a different way of running a business. Maybe it's a different set of family values. So that communication is one of the most critical pieces that people like myself, Karisa, and Rick are facilitating, whether it's on the financial planning or on the business family dynamic planning. So thank you for that. Good question.
And so I just point out to everyone that we have 7 minutes left. If you have some more questions, fire away, and Ron will continue.
Thank you, Rick. So that ties into, we talked about the business life cycle. This is a typical financial life cycle of an individual that we would work with. And we would see, you've got your current assets and your investment assets are starting to build up. And at some point, you're going to have a sale of your business, or maybe you've sold some real estate. It really doesn't matter where you are in here, whether you're in the pre-retirement, the active retirement. It is important to always be planning, just like any business. You don't set it and forget it and say what worked 2 years ago is going to continue to work. You don't just produce one line of potato chips. You produce multiple flavors, different types of shoes, and so forth. So overall, it is about putting it together to see how the different cycles connect, both the business and the corporate and the personal. It's what we would call comprehensive planning, and is probably the most overlooked and fundamentally important part of anything that we do with our clients. Because when we talk about integrated, it's integrated in terms of how we work with our clients. It's not just about retirement income modeling. That's what most people will do. Okay, I've got retirement income, I'm done. We want to look at, well, how are your stocks and bonds playing into this? Again, we move beyond stocks and bonds. When you start looking at a financial planning scenario, this is what a strategic business plan might look like when you get started. And if you're doing your job at running your business, it becomes this beautiful timepiece. And the idea is helping you put it together. But what's your priority? I talked about this earlier when I said you have multiple competing priorities. Are the gifts to the children and the grandkids more important to you than giving away, or your lifestyle, or a bucket list, or travel, or recreation? Or are they all equally important? And now we have to help you decide, prioritizing what's most important. So I think if there's one takeaway from today, and if I could just wrap it up, don't think in silos. Don't think in terms of individual business is over here and my family matters are over here. When you're running a family business, they're integrated. They're integrated in so many ways, and it's important to have somebody alongside of you for that journey.
Yeah, that's a great wrap up. Hey, Karisa, if you want to come back on, we're down to the last few minutes. So, Karisa, is there anything that you'd like to add before we wrap up here? Just a closing comment before we move on.
Sure. Really just echoing what you have both already indicated. One, communication is really important. And two, planning is multifaceted. And your planning should evolve just alongside your life as your life unfolds. So there's no setting and forgetting it. Always looking at what's at the forefront, kind of have your discussions around that. But certainly it should be evolving.
Yeah, that's great. Then Ron, any closing comment before I wrap things up?
I'll add to that, maybe build on what Karisa said. John Lennon said in his Double Fantasy album, 1984, he said, "Life is what happens when you're busy making plans." I like these quotes because they are so true, because none of us predicted or saw what was going to happen as a result of COVID, how we've had to pivot, how many of us have had to thrive and been able to, thrive. But it is planning, and it is constantly reevaluating. So when you are working with, Karisa, myself, and Rick, we're meeting with our clients on a frequent basis. And the first question is always, what's new with you? And that's what we want to know. We want to know what's new with you so that we're always making sure we're pivoting and providing the value. Thank you for the opportunity to speak to all of you today.
Yeah. So I just want to wrap up now and just remind everybody that the webinar, as you can see, was titled The Family Business Life Cycle. So first of all, in the life cycle, we've tried to highlight that it's really important to understand a business and how it evolves, because as the life cycle takes place in the business, it's actually matching the life cycles of individuals, which is quite fascinating. So when you look at the family business you may be involved in, is it now the first, second, third, or fourth generation? And what's the life cycle of that business? Is it on the growth phase, the plateau, or even possibly decline? And then you match it up with your own life cycle. At whatever stage of life you're at, are you trying to take risks to build a business, or are you more of a custodian? And then we talked about creating and distributing wealth. Sometimes planners may talk just about the distributing, but we work with families holistically and understand the entire dynamics of the family situation. And there's a number of important things you can do to keep creating value in the business, which is then that platform, of course, for distributing wealth. You can see our email addresses there, so we'd encourage anyone who wants further information, please contact any one of us and we'll follow up with you. So I'd like to thank you for joining us today. Thank you for the questions that were posed. I see there's a few more questions that came in, but we'll try to respond to those via email. Once you leave today's event, you'll receive a survey of the presentation, and we'd really appreciate it if you could complete the survey, as the feedback will be valuable for us. You'll also receive a follow-up email within 24 to 48 hours with a link to the recording of today's event. So that may be something you want to refer to. So on behalf of Nicola Wealth and Ron and Karisa, I want to thank everyone for joining us today. And as guaranteed at the outset, I'm pleased to say Dale Carnegie would be proud. We've ended exactly on time. So thanks a lot and look forward to staying in touch.